The biggest rallies of the last few years happened in assets everyone already knew about. Gold, a steady, relentless climb. The asset your grandfather owned is now printing new records. SPX, same story. Nvidia didn't just pop on AI hype. It's been building for years. Bitcoin from early 2023 to now. One long, grinding move upward. None of these were hidden. None of them were secrets. They were category leaders, sitting in public view with charts anyone could read. And yet, most people only noticed after the move already happened. They were busy chasing hype, hunting for clever picks, and ended up underperforming or losing money while the obvious assets just kept going. So the question becomes, how do you buy the right assets before they rally? I'm Mike, head researcher at Asymmetry Labs. After years of trading and researching financial markets, here's what I've learned. The answer isn't finding hidden gems or chasing outperformers. It's simpler. Choose the category leader and know when to buy it. Here's how I'll break it down. First, why you should focus on category leaders instead of hunting for outperformers. Then, why rallies happen mechanically. After that, how to choose the right asset for you. Then, technical analysis to detect safe entry zones. And finally, how to execute. The dealer mindset, limit orders, and scaling your position over time. Let's get into it. So, what does that actually mean, choosing the category leader? First, you define the sector or theme you want exposure to. Then you pick the most obvious asset in that category, the one that institutions and the crowd default to when they want that exposure. I call this the alpha. Not alpha as in returns, but alpha as in the dominant player. The category alpha. From here on, when I say alpha, that's what I mean. Monetary hedge, gold is the alpha. Broad stock market, SPX, crypto beta, Bitcoin. AI boom, Nvidia. Why not hunt for the outperformer? Because the 1,000% gains usually go to two groups: people with real informational edge, like insiders or those working deep in the field, and people who simply got lucky. If you're honest with yourself, you're probably neither. And that's fine, because we're not trying to compete there. Buying the alpha is repeatable. It's liquid, it attracts big flows, and it tends to benefit when the theme is hot. This doesn't mean the alpha always outperforms. It means the alpha is the highest probability vehicle to express the theme without needing genius-level selection. And that brings me to the real edge. It's mostly when you buy the alpha, not what you pick. Buy the alpha at the wrong time, you still suffer. Buy the alpha during the boring base, you capture the move. So now, we've defined the target. Next question. Why do these rallies happen in the first place? Once you understand the mechanics, you'll know exactly what you're waiting for. A rally isn't a miracle. It's a flow problem. Price moves when demand shows up faster than supply can absorb. Three things need to align. First, a demand surge, often from reallocations or forced buying, not just retail excitement. Second, supply constraint, meaning there aren't enough willing sellers at current prices. Third, a simple narrative, a reason that's easy to repeat so more buyers pile in. When all three hit at once, price moves fast. Once you see rallies as flows plus supply plus narrative, gold's move stops looking mysterious. Zoom out. Money expands over time. That's the system. So capital is constantly searching for assets that protect purchasing power or dominate a theme. That's why you see waves into broad equities, into tech leaders, into hard assets, and into crypto. It's not random. It's rotation. Now, gold isn't just people are scared. The rally was driven by stacked demand, central banks accumulating, record ETF inflows, falling rate expectations, and uncertainty premium all hitting at once. Demand surged from multiple sources, supply doesn't respond quickly, and the narrative is simple. Store of value when uncertainty rises. Here's where most people mess up. They try to predict the exact trigger for the next leg. But after a long consolidation, the move is often set up. The conditions are there. You just don't know which headline flips the switch. It's like going to the sea because you believe there are fish. You don't know the exact minute or exact spot you'll catch one, but you know the conditions, and you show up prepared. So the first job is choosing the right C, choosing the right category. Then you pick the alpha and focus on entry timing. So you understand the mechanics. Now you need to pick your C. Pick your category based on where you have iterations, real reps, not what's trending on social media this week. Why? Because you have insights that outsiders don't. You know what's actually happening in the field. You see the shifts before they hit the headlines. You can tell when the narrative is real and when it's hype. That's edge you can't fake. If you've lived through crypto cycles, your alpha is Bitcoin. If you work in AI or study the space deeply, pick AI and default to the leader. If you don't have deep expertise in any particular field, or you're still building your trading skill set, gold or SPX are great defaults. They're liquid, they're understood, and they don't require you to interpret complex industry dynamics. So pick the category you have reps in and choose the alpha. That part is done. From here, the question is not what do I buy, it's how do I buy it at a good price before the move happens, because the alpha is obvious. The entry is where most people mess up. Now we go to the weekly chart, not to predict headlines, but to find the boring base and define exactly where we're wrong. Here's Bitcoin on the weekly. From early 2023 to the peak, around 120,000, this is the move. One long trend. The goal was never to catch hype or predict headlines. The goal was to buy Bitcoin at a safe price before the move became obvious to everyone else. So let me replay back to the end of 2022. After a massive downtrend, price eventually goes flat. Look at the candle bodies here. They get short, boring, dead. This is information. Selling pressure is fading. The market is finding balance. Now look at the RSI. It's been sitting in the low zone for a while. And notice how price makes a lower low, but RSI doesn't follow. That slight divergence is telling you something. Momentum is not confirming the weakness anymore. Price is still below the EMA 200, the pink line, so we're still in recovery mode. But stabilization is the key. This is where attention should start. Now let me move forward to mid-2023. Price reclaims the EMA 200. And watch this candle here. A long wick sweeping below, then a strong bullish response. This is what a structure shift looks like. After a long downtrend, the market changes character when sellers stop making progress and buyers start defending higher levels. But we don't rush to buy right after a big bullish candle. We wait. We let price come back to us. Fast forward to near the end of 2023. Price is holding strong above the EMA 200. And there are multiple opportunities here. See how price drifts back, moves slowly, flattens near that pink line. When price is calm near a support reference, your drawdown pressure is controlled. That's a safer entry. Now back to the full chart. The safe price zones were in the lows of 2023 and during the calm retests of the EMA 200. Nothing fancy, no prediction required. The longer you held from those zones, the more profit the trend delivered. Now let me show you the same pattern on SPX. This is the SPX weekly chart for the last 10 years. SPX is the category alpha for the entire stock market. If you want broad equity exposure, this is the default. Look at what happens repeatedly. When price nukes into the EMA 200, or even below it, those zones tend to be the safest prices you get in the whole cycle. Historically, if you can buy there and hold, the market rewards you. But buying there feels horrible in real time. That's exactly why it works. Most people only want to buy when it feels safe, which is usually after the move already happened. Look at the RSI during those nukes. It's sitting in the low zone. Same story as Bitcoin. The market gets washed out, movement slows, and that creates the opportunity. So what do? I want to buy when price is near or below the EMA 200 and movement starts to slow down. I'm building a position, not smashing one big buy. Then I hold and let the next rally pay me. Now look at gold. Same idea. Gold is the category alpha for hard money, the trust asset. When people lose faith in policy or want to hedge uncertainty, this is where capital flows, and the pattern repeats. Look at the times price came back near the EMA 200 and then went flat. Boring candles, short bodies, movement slows down, then the next leg up begins. 3 ingredients across all these charts: the EMA 200 as your reference line, RSI getting low or washed out, telling you the market is tired, and price action that flattens near support. When those ingredients line up, that's my zone to build a position. I'm not smashing buys when price is vertical. I'm buying when it's boring and no one cares. Same recipe: Bitcoin, SPX, gold. EMA 200, washed RSI, flat price action. That's the environment you're looking for. So you've found the environment. Now, how do you actually enter? Here's a principle that changes everything. The less drawdown you experience, the safer your holding becomes. Not just financially, but psychologically. You can sit through noise when you're not underwater. Think of it like a car dealer. A dealer doesn't make money when they sell the car. They make money when they buy it. Their whole edge is buying below market value, so by the time they sell, the profit is already locked in. Same logic applies here. You don't smash a market buy the moment you see the setup. That's emotional. Instead, you use limit orders. You set your buy below the current market price and let the market come to you. How much discount? It depends on the asset and the volatility, but a few percent below market price is a reasonable starting point. You're not trying to nail the exact bottom. You're trying to get a better price than the crowd who buys on impulse. And you don't do this all at once. You split it up, one limit order at a time. Maybe you finish accumulating over weeks, maybe months. The boring base isn't going anywhere fast. That's the whole point. The goal is to enter at a good enough price that even if the market chops for a while longer, you're not shaken out. You profit on the buy. Now let's talk size, because this is where most people get it wrong. Too small, and even if you're right, it doesn't matter. The gain doesn't move the needle, too big too early, and the first pullback shakes you out. You were right on direction but wrong on size, and you liquidate yourself emotionally before the move even happens. The solution is to build size as uncertainty reduces, not all at once, in tranches. First tranche is your starter, around 30% of your intended position, small enough that you don't care if it chops. This is just to participate, to have skin in the game so you're paying attention. Second tranche comes on confirmation. The base holds. Price makes a higher low. The structure you identified is proving itself. Now you add, third tranche comes on acceptance. The character shifts. Maybe price reclaims and holds the EMA 200 on the weekly. The market is telling you something has changed. Now you're sized properly for the move. The point is not to nail the perfect entry with full size. The point is to scale in as the market proves you right. Size so you can ignore the noise. This isn't designed for constant flipping. It's designed for holding through the move. Now let's talk about when you're wrong. Invalidation isn't about a specific price level or a headline. It's about risk management. Before you enter, you decide how much of your total capital you're willing to lose on this trade. Let's say 10% is your maximum. If that level gets hit, you cut. Even if you don't want to, even if the chart still looks okay to you, you cut, you reset, and you start fresh. This isn't about being right. It's about staying in the game. One bad position that you hold too long can damage your capital and your psychology for months. Accepting a loss and resetting is how you preserve the ability to take the next opportunity. Define your risk before you enter. Honor it when it's hit. So let's bring it together. Choose the alpha, the obvious leader that institutions and the crowd default to. Don't waste time hunting for hidden gems or trying to outperform with clever picks. Wait for the boring base, the weekly range where no one is paying attention and price is going nowhere. Buy like a dealer. Use limit orders below market price. Split your buys over time. Enter at a good price so your profit is built in from the start. Less drawdown means safer holding. Scale as the market proves you right. Start small, add on confirmation, size up on acceptance. Let uncertainty reduce before you commit fully. Define your risk. Know how much you're willing to lose before you enter, and honor that line if it's hit. You don't need to predict the trigger. You don't need to know which headline starts the move. You just need to be positioned before it happens. And here's the final reminder. Be patient. The nuke will come. It always does. Maybe not today, maybe not next month, but probably sooner than most people think. So prepare your capital now. Make your plan now. Know which alpha you want, know the price zone you're waiting for, and be ready to act when everyone else is panicking. That's the edge. This is Asymmetry Labs. See you.